Over the past month, I have made some moves in the YouTube portfolio. In total, I have sold out of 2 stocks and used the funds to add to 2 positions and buy one brand new one. So in today's video, I want to discuss the moves I have made, why I made them, and how the YouTube portfolio is performing as of today. This is a way for me to track the stocks that I discuss here on the channel and see if I can outperform the S&P 500 over time. Now, while we're on the topic of portfolios, I want to thank Webull for sponsoring today's video. Webull is the one-stop trading platform for US and Canadian stocks, with over 10,000 stocks and ETFs on their platform. Webull has charting and research tools, and over 60 technical indicators. Additionally, Webull has TMX Level 2, CBOE Level 2, and NASDAQ Total View. This means that Webull has in-depth, real-time data on major Canadian and US exchanges. If you're interested in checking out Webull and getting access to all of these features, then click the link in the description of this video. Upon signing up, you are entitled to 90 days of free trading, and you can earn a maximum $100 cash reward if you deposit $1,000 or more. That's a 10% return simply for signing up. Additionally, Webull offers a cash account with an attractive 4% interest on uninvested Canadian funds and 3% on US dollar funds. And thank you again to Webull for sponsoring today's video. Alright, so now let's hop into the video and discuss the number one thing that most people want to know immediately, which is how is the YouTube portfolio performing so far against the S&P 500. So here we're taking a look at a year-to-date chart, and we can see that as of April 16th, the YouTube portfolio is up 6.4% on the year versus the S&P 500's 5.9%. So as of April 16th, the YouTube portfolio is slightly outperforming year-to-date, but it is also worth noting that it kind of has been changing between the YouTube portfolio outperforming and the S&P 500 outperforming so far this year. However, if we take a look at a max view, we can see that the YouTube portfolio is currently up 55.6% versus the S&P 500's 32.4% since I started tracking the YouTube portfolio on the channel. So over the longer term, it is outperforming by a pretty significant amount, and now year to date, it is also slightly outperforming. So we're going to have to continue to see if that is the case over the rest of the year, or if I do start to underperform during this year. So now let's get into what is currently in the YouTube portfolio. And here we can see that there is 15 values, including basically a 0% cash position. So there are 14 stocks within this portfolio now. And if you want to pause the video, then you can take a look at all of the different allocations here. Now let's move on to the moves that I have actually made recently. And the number one biggest move is that I have sold out of my BIP position. Now, before I dive into why I sold the BIP position, I want to make it extremely clear that I am actually still bullish on the long-term future of this stock, and I do think that the stock will actually perform okay going forward. So I want to make it clear that I did not sell BIP because I think the business's fundamentals are deteriorating or anything like that. I will dive in very deep as to why I sold this position and my reasoning behind it in a couple of minutes here. But first, I want to move on to the other sell, which was Fortinet, and I have completely sold out of my Fortinet position. In the last YouTube portfolio update, I did say that I believed Fortinet was the most expensive stock in the portfolio, and if I did find another stock that I thought was a better investment opportunity, then Fortinet would be the one that I would sell out of to fund that investment opportunity. And I do believe that I have now found a better investment opportunity, but unfortunately, this is a very small cap Canadian stock that doesn't have a lot of volume, and the market cap is very low. So I don't want to say this stock publicly on the YouTube channel. And I'm sorry about this, but I just simply do not feel comfortable sharing low market cap illiquid stocks on my public YouTube channel. My Patreon community does know which stock this is. So if you do want to get access to know which stock this is and follow all of the portfolio updates in real time, along with my own personal portfolios, then I would recommend checking out my Patreon. But this is just not something that I'm going to share with the public community. Now, if I ever end up selling this stock, or if the stock grows into a larger market cap, then I will eventually share it with the overall YouTube channel. But for now, this one is a Patreon only stock. So now let me quickly explain why I decided to sell the Fortinet position and why I thought that the stock was actually looking quite expensive. So right away, when I sold the stock, it was trading for a price to free cash flow of just over 30, which is above its 10-year historical average of 27.5. So its price ratios were selling quite a bit above its historical averages. Additionally, Fortinet is projecting roughly 8.7% revenue growth for the year of 2024. And when I was taking a look at this price ratio of 30 with projected revenue growth of only 8.7%, that is kind of leading me to believe that the stock is actually quite expensive. A 30 multiple for less than 10% growth, I do think is quite expensive. And that is also why I believe that Fortinet was actually the most expensive stock within the YouTube portfolio. If we also take a look at Fortinet's long-term year-over-year revenue growth, we can see that it did have the lowest revenue growth in 2013 at about 15.3%. What this means is that 2024 is projected to be the lowest amount of revenue growth that Fortinet has ever had in the business's history. Now that's interesting to me because Fortinet is also selling above its historical average price to free cash flow. So it's selling for a high price while the business is literally seeing the least amount of revenue growth in its entire history. So those are all things that I consider when I am taking a look at the valuation of any business. So I hope that quickly explains overall why I ended up selling this position for a decent gain of around 20% and kind of clears up the air there. Now moving on to BIP, which is Brookfield Infrastructure Partners. Now I ended up selling this one because I actually never really intended on owning it in the first place. I ended up buying this stock down here in this massive dip in October of 2023 when there was a short seller report that came out on BIP. I went through this short seller report on my channel, I dissected it, and I came to the conclusion that the short seller report was just flat out wrong. And overall, I used that as a buying opportunity to buy BIP shares when I believed that they were ridiculously cheap and too cheap to ignore. But again, I never really planned on owning BIP because I already have such a large allocation to Brookfield through Brookfield Corporation, the BN ticker, and Brookfield Asset Management, which is the BAM ticker or the BAM ticker. BN specifically actually owns a very large position in Brookfield Infrastructure Partners. It's one of their subsidiaries. So through owning BN shares, I already have a very large position in Brookfield Infrastructure as well. And from the dip that I was buying BIP shares in October, the stock recovered roughly 40% and became around the area where I thought that it was selling for about fair value. And I thought that from this price, the stock would maybe offer 8 to 10% annual returns going forward, which is still pretty good returns. And as I said, I do actually think that BIP's fundamentals are still very strong and the business will continue to perform well over the long term. But the entire point of the YouTube portfolio and the entire point of my own investing is to try and outperform the S&P 500 over the long term. So if I believe that a stock is going to deliver the same returns as the S&P 500 or slightly lower returns than the S&P 500, then overall, I think that I have to cut it from the portfolio because I want to really strive for outperformance. So if a stock gets to a point where I think that it's selling for fair value and is going to underperform or just have the same performance as the S&P 500, then I want to let it go in the portfolio and use that money to allocate it to positions that I think will outperform. So on BIP, I ended up making around 40% on this position within 6 months, which I am very happy about. And now those gains are working for me in other stocks that I do think will continue to outperform the S&P 500 over the long term. So now let's get into what those stocks are. The two stocks that I added with the BIP funds are Alimentation Couche-Tard and Go Easy. Now I recently did a video on my channel, which was the 3 Canadian stocks that I am buying in April of 2024, and Alimentation and Go Easy were discussed pretty in depth in that video. So the information that I'm going to be providing in this video now, kind of explaining a little bit more about these businesses, is brand new, and it's information that I have not discussed yet on the channel. So there is going to be some new information with these two businesses right now. So let's quickly discuss Alimentation first. And right away, this is a global convenience store business. They have a network of around 16,700 convenience stores around the world now. They're mainly operating in North America, in the United States, and Canada, however. Now, what's super interesting is a firm called NK Capital on Twitter put out an Alimentation report recently, and they provided some pretty interesting information that I'm going to share now. So this chart right here shows that ATD has outperformed companies like Microsoft, S&P Global, Adobe, and even Google since 2007. So yes, Alimentation is a boring business. They own a global network of convenience stores, but the stock price has outperformed these major tech companies over the past about 20 years now. Alimentation has also outperformed Home Depot, Costco, Walmart, and Dollar General. So these are companies that are also massive retailers across the world, and Alimentation has outperformed them as well. Now, even when we compare Alimentation to its own industry, again, the convenience store industry, we can see that it is the #1 top performer. When we compare it to Murphy's and Casey's, ATD does come out on top, and it has outperformed these other two stocks by quite a wide margin. So this is a very high quality business that has a history of consistently outperforming the top stocks in the market. Now what's interesting is despite Alimentation outperforming its own peers and some of the best stocks in the market, its forward price to earnings ratio is still on the lower end at only 19 times, whereas Casey is at 24x and Musa is at 15, and all the other businesses that were compared to ATD are selling for quite significant premiums to this business. Now moving on to some of the fundamentals of Alimentation. Right here we can see that its US same-store sales have been consistently growing every single year for the past 20 years. The company has been able to grow its in-store, same-store sales through 4 economic recessions, the Great Financial Crisis, the global pandemic, oil price spikes, and even through the rise of big box, rise of e-commerce, and rise of last mile delivery services. So through all of these major economic events and through events that should be disrupting Alimentation's business like e-commerce, the company seems to just not care, and its same-store sales seem to continue growing. Moving on to this next slide, this says that Alimentation has small impulsive buys, and the average is a $7.50 ticket, which is the smallest retail ticket. So on average, a customer spends about $7.50 at an Alimentation convenience store. Now these C-stores or the big retail competition simply cannot compete with that. They cannot sell items at an average of $7.50 at a profitable margin, whereas Alimentation specializes in doing so. So these large businesses like Costco, Walmart, Amazon, and DoorDash cannot compete at that low cost that Alimentation currently serves. And in my opinion, this is why Alimentation has such a strong moat, and really the convenience stores have such a strong moat as well. Now, additionally, Alimentation only has 5% of the convenience stores in the United States, and 60% of the convenience stores in the United States are operated by single store operators. So they are not part of any massive network like Alimentation. And I think there is still a lot of room for consolidation within the convenience store industry, just in North America, not even globally. So I do think that Alimentation still has a very long runway for future growth. In fact, Parkland, which is a large Canadian convenience store business, is planning to sell 157 of its convenience store and gas station locations. Additionally, Shell is looking to sell 1,000 of its convenience stores by 2026. So there is still a lot of consolidation happening within this industry, and a lot of other convenience store operators seem like they cannot operate their convenience stores at a profitable margin, whereas Alimentation can. So it looks like there is still a large opportunity for Alimentation to acquire a lot of convenience stores in North America and expand its overall network and business going forward. Now this last slide right here shows that Alimentation is projecting 11.7% compounded annual growth rates to its EBITDA over the next 5 years. So this business is still projecting to grow its overall profitability at double-digit growth rates over the next 5 years, even though we are kind of entering a little bit of an economic slowdown. Now, very quickly, if we head over to Stock Unlock's discounted cash flow calculator, and we project out Alimentation's EBITDA over the next 5 years at that 11.7% compounded annual growth rate, with 3% annual buybacks, which is what the company does, and 22% dividend growth rate, which is also the company's historical average dividend growth rate. And lastly, with a 9 price to EBITDA, which is the company's 10-year average, then we get a compounded annual growth rate of roughly 16%. So basically what this means is that if Alimentation shares trade for their historical average price ratio, and the business meets its goal of continuing to grow its EBITDA by 11.7% annually, then the stock could deliver around 16% compounded annual returns over the next 5 years, which is a great return rate and a return rate that is above the historical performance of the S&P 500. So you can kind of see why I sold the BIP shares and used those funds to buy Alimentation while it is currently in that about 20% dip from its all-time highs now. I simply think that this stock will outperform the S&P 500 and outperform BIP shares over the next 5 years now. All right, now let's move on to the next stock that I used half of the BIP funds to purchase, which is GoEasy. Now again, I recently talked about this stock in a previous YouTube video, so I want to present some new information in this video. So here we have the quarterly highlights from GoEasy. And very quickly, GoEasy is a subprime lender within the Canadian markets. That is their entire business. They offer a bunch of different loan products to people who have subprime credit scores in Canada. Now here we can see their quarterly highlights. And this says new customer acquisition. Record quarter for application volume at 531,000, up 29% year over year. They also had 40,300 new customers, up 15% year over year. So the business is still continuing to grow at double-digit growth rates, and this is one of those businesses that just continues to surprise me every single time it reports its earnings. It just continues to grow every single metric by over 20%, it seems. Now in GoEasy's auto financing business, they had record quarterly originations exceeding $100 million and up 48% year over year. So for those of you who do not know, GoEasy recently entered the auto financing industry within Canada. And this subsegment of the business has been growing incredibly well, and it's still growing at 50% year over year. Now, GoEasy's point of sale financing originations also grew 50% year over year, and they added over 380 new merchants in the quarter. Their point of sale financing is now offered through a record 9,500 merchants across the country. So GoEasy's number of merchants that they have within their platforms is growing by roughly 15% year over year as well. Now, this slide right here was also provided by GoEasy in their most recent investor presentation. And this slide shows the different delinquency rates of super prime, prime plus, prime, near prime, and subprime lenders. Now, what's interesting is that during the 2001 tech bubble collapse, subprime lenders' delinquency rates, and they were the only credit group to see their delinquency rates go down during the tech bubble collapse. So subprime lenders actually saw their loss rates decline during the tech bubble collapse, which I do think is very interesting to note. Now, additionally, during the Great Recession, these subprime lenders saw their delinquency rate decline from 15.2% to 15%. And once again, they were the only credit group that saw their delinquency rates go down during a recession. So basically, during the last two major economic events, subprime lenders have seen their credit quality improve throughout those recessions or throughout those major economic events, which I think is very interesting. And it also suggests that GoEasy's business should perform well during an economic downturn, because throughout the previous two major economic downturns, their customers actually fared quite well. Now, additionally, GoEasy is projecting roughly $1.8 billion in revenue in 2026, and it is also projecting its operating margin to continue expanding and grow to above 41%. The math works out for this to be a roughly 15% compounded annual revenue growth over the next 3 years, and 15.7% compounded annual operating income growth over the next 3 years as well. Now, if we do a very quick DCF calculation over at Stock Unlock using GoEasy's operating income over the next 3 years, and we input their own projections of 15.7% annual operating income growth over the next 3 years, with a 6 price to operating income, which is the company's historical average, then we get a compounded annual growth rate of roughly 18% from where the stock is currently trading. This is another very strong annual return over the next 3 years that is also above the S&P 500's historical average, and what I do believe BIP shares will deliver from the current share price, or at least the share price that I sold the stock at. So you can kind of see why I use those funds to buy more GoEasy as well. So those are all of the moves that I have recently done within the YouTube portfolio, and I would love to hear your thoughts down in the comment section below. And also, if you do want access to all of the buys and sells that I am doing within the YouTube portfolio and all of my personal portfolios in real time, and also see all of the stocks that I own, even the small cap ones that I do not share with the YouTube channel, then go and consider subscribing to my Patreon. My Patreon members also get a list of other benefits, such as Patreon-only videos, my thoughts on the overall market, all of the stocks that I am buying and selling, real-time updates on my portfolio, videos on my personal portfolios and all of my portfolio analysis, and even more. So if you're interested in any of those things, then again, please consider becoming a Patreon subscriber. It is the #1 way to support my content, my work, and my YouTube channel. But with that being said, that is going to wrap up the video, everyone. So thank you so much for watching. As always, I truly do appreciate it, and I really hope to see you all again in my next video.